Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. I want to welcome you once again to a subscriber request Tuesday series that I've been conducting for some time now, where I try to cover stocks or ideas that subscribers have asked for, things that you as a subscriber to our channel are interested in. And in this particular Tuesday, I've been asked quite a bit about going back to dividend growth stocks, which is really what I'm personally most interested in. Although I do try to give a lot of, variety to the channel I like to, I did a video on gaming stocks, which are more for the younger oriented people. I've done growth stocks. I've done MLPs. I've done REITs. Here today, I'm going to go into the Dividend Contenders list. Now, I want to be very careful when I say this. I'm going to be offering 11 stocks that are dividend contenders. A dividend contender is a company that has increased their dividends by at least 10 up to 25 years. Okay. They're just short of the dividend aristocrat or dividend champion status, which are companies that have increased their dividend for 25 straight years. So the point I want to make is, if it's not on a dividend contender list, I'm not covering it. So don't ask me about a stock that isn't on that list, because many of you often do that. This is strictly all about dividend contenders. And what I want to talk about a little bit is, dividend growth stocks, okay? And I'm going to emphasize in this video the word growth, either growth of the dividend or growth of the actual company itself, okay? So the idea here is these are going to be primarily, for the most part, oriented towards good total return investments you can buy at attractive valuations, because valuation is really what this whole channel is all about. The FastGraphs channel is about identifying very attractively valued stocks that you can invest in for the long run, that provide you some level of a margin of safety, but at the very worst, an attractive, sound, fundamental valuation that you can then therefore position yourself to participate fully in the benefit or the results that the business generates on your behalf. Because we all want to invest in great companies. We always want to do that, and people do that pretty well. They will identify, we know what the good companies are, what the favorites are, what the best names, the highest quality companies out there are. The problem is most of us don't understand how to buy them at attractive value. So I'm going to look at 11 stocks here today that I consider to be attractively valued dividend contenders, companies that have increased their dividends by at least 10 consecutive years in a row. Okay, but before I do that, let's go ahead and get into the video. Let's start by looking at the S&P 500 and talk about this as our benchmark, if you will. Now, for those of you not oriented with FastGraphs, the orange line plots the earnings per share, in this case of the S&P 500 index. It is plotted at a multiple of earnings, which is historically normal in the case of the overall market, of a 15 PE ratio. The average is somewhere between 14 and 16. So this is a 15 PE ratio. I will be adding another valuation reference line to the graphs, which is called the normal PE ratio. What the normal PE ratio is, you could call this the normal market value. Okay, there's a difference between market value and intrinsic value. The orange line is attempting to depict intrinsic value. The blue line is kind of including market sentiment, whether the market's being optimistic or pessimistic at any point in time. And then finally, the point is that the price of, in this case, the index is going to go where the business or the businesses in this case go. So now I'm going to overlay monthly closing stock prices on the graph. And to oversimplify this, when the price is above either or both of these lines, that's an overvalued situation. And I want to point out, very importantly, that the market was overvalued in 2001, which was coming into the first recession we had on this particular graph. Then from roughly 2002 into the Great Recession of 2008, the market was trading at normal ranges, a little pricey at times, but pretty normal. And then, of course, we had the market fall in value, but we also had earnings falling in value, which was the Great Recession of 2008 and 2009, and stock prices followed that. And then since that time, we've been in one of the longest running bull markets of all time. But I want to make a very important point. the market was behaving properly, in my perspective, normally for the first 4 or 5 years, where it was trading at really discounts. It actually offered margins of safety. This was really tremendous time to be buying common stocks, or for that matter, investing directly in the S&P 500 index. Then, as we kind of entered 2014, by the time we got to the end of 2014, we start hitting what I would consider to be the upper limit of valuation on the market. And then since that time, we've had some pretty high valuations, and we're currently, in my view, in a very inflated stock market. Now, I bring all this up for a couple of reasons. Number one is, and I had this as a quote-unquote comment/criticism on one of my recent videos, saying it was unfair to compare the S&P because it was dramatically overvalued back in 2001. Well, I'll be showing performance of these companies, long-term performance, a little later here in the video. But yes, that's true. But it's also unfair to compare stocks to a market when its ending value is so overvalued now, especially when I'm going to be showing you attractively valued stocks. So I want to be clear. The S&P we're measuring from overvaluation, the PE of 28, to a current PE, blended PE of 23. Both cases, the market was overvalued, okay? But this is what the market looks like, and the problem is I don't want to invest in the market now because I consider it too expensive. So the question is, it is a market of stocks and not a stock market. So I'm going to look for stocks that are attractively valued that I can invest in, that would hopefully give me good dividend growth as well as good capital appreciation potential over time. And the list I've chosen to do that is the Dividend Contenders list. Okay, now the CCC list was originally created by David Fish, rest his soul. He was a friend of mine who passed away a year or two ago. And it's now been curated and maintained in terms of David's legacy is being kept alive by Justin Law, another business associate and friend, who's now curating these CCC lists. The lists are champions, contenders, and challengers. Okay, challengers have increased their dividends from 5 to 10 years. Contenders from 10 to 24 years, and champions from 25 years or more. One thing about the contenders list, which is what I'm going to be gathering, where I've gathered the names that I'm going to be covering in this video, are the contenders list are companies that have increased their dividend by 10 to 25 years. And you can see these are in streaks. You can see the over 10 years dividend streaks here, the number of years they've increased their dividend. So I'm looking at contenders here, but some of these names I really don't like, even though they've got the dividend streaks. So what I've done is I've put together a list of 11 dividend contenders that I consider to be extremely attractively valued now and extremely high quality. All of them are A-rated or better, except 2 that are triple B plus, which is one step below. You could say all of them are investment grade. They're all very high quality companies, and they have some very similar characteristics, which I'll be highlighting here. Now, since I'm covering 11 stocks, obviously I'm going to go through this quickly. This is a pre-research perspective. In other words, these are research candidates that I think you could look at more deeply if you're interested in any of them, depending on what your goals and objectives are. If you're a dividend growth investor, I've got a little bit of everything here. I'm going to list these in order of the highest dividend yield to the lowest. And I want to make a point. With the higher yielding stocks, as a general statement, and there are exceptions to this, you're going to have less growth potential with more current yield. For the companies with lower dividend yields, you're going to have more growth potential as a general rule. But again, there are exceptions to that. So what I've done is I've presented these stocks in order of highest dividend yield to lowest. Okay, so I'm going to be starting with the first company I'm going to share here on this 11 group is Spire, which is a gas utility stock. Now, the couple of things about this particular company, and I want to make sure that you're seeing this. I'm looking for companies that basically have this characteristic of what I consider to be very consistent earnings growth. Now, there's going to be occasional blips, in the screen here, but generally speaking, these are steady Eddie growers. But the key is the dividend growth, which is this white line, is really what we're focusing on, in today's video here. Now, Spire has a dividend growth streak of, I've forgotten, let me go back to it. Spire has a dividend growth streak, and it's a dividend contender, I want to point out. So I'm going to go here on the list, show you how I determined this, okay? And I'm going to look up Spire, And I've got it right here, SR Gas Utilities, 18 years of consecutive dividend increases. Okay. Now, the next thing I want to point out is price. When the price is on the orange line, it's fairly valued. Below the orange line, it's attractively valued. And above the orange line, it's overvalued. That's just as a general statement. And you can see that very clearly here. So if I look at, price, monthly closing stock prices, first of all, you see that the price ultimately goes where the earnings of the business goes. And again, I do this over and over again. When the price gets disconnected, like here, it was coming into the Great Recession, it was very overvalued before it finally corrected. And then, of course, the earnings even corrected. But note that the dividend increased. It went from $1.54 to $1.58. The stock was fairly valued at the beginning and is fairly valued to slightly undervalued today. Dividend yield is 4.12%, which is, again, the highest yielding one I'm going to show. Earnings growth has been 5.48%. The company is A- rated with 47% debt. It's a very solid, gas utility stock here. And when it was overvalued, over the last 4 or 5 years during this bull market, it is a market of stocks, not a stock market. It got inexpensive again. It went and got overvalued again. Now it's back to a point where I think it's attractive again. If I look at it from a historical performance point of view, had I invested $10,000 on December 29th, 2000 and held it to yesterday's close, the first thing that I want you to see is my dividend income would have grown by an average of about 3.5% per year. It started increasing the dividend in 2004 and increased it every year at around, 3 to 5%. You can see that range is different. If I shorten this time frame, I'll shorten it down to 14 years, just so I get into it. You can see that they've actually been raising their dividend about 4 years. But going back to this long-term performance, what I want you to see, when it started out fairly valued and it's now fairly valued, it produced over $15,000 in dividend income compared to $4,600 in the S&P 500. It underperformed the market just ever so slightly, averaged about 4.9%, which, by the way, and this is extremely important, is very consistent with the company's earnings growth rate adjusted for valuation. It was trading at a 15.7 PE in the beginning here, and now it's trading at a 14.2. So that, that's a little bit of PE contraction, if you will, that took the 5.48% growth and lowered it to 4.9. Ever so slightly. But now you add in all the dividends and it actually beat the market very slightly on a total return. But the point is, if you were investing for income and you were living off of your dividends, for example, you got this beautiful increase in pay every year. You started out with a pretty high yield of about 5.7% in 02. That by last year, you'd have got just under 11%. And of course, the dividends expected to grow again this year. That's the advantage of investing in these dividend contenders, these companies that raise their dividend year after year after year. Okay, this is the highest yielding one. You can buy this today at a current yield of 4.12%. It isn't going to generate a great deal of capital appreciation, but I would look at this as a 9 to 10% annualized rate of return opportunity here with a 4.12% dividend while you're waiting. Now, by the way, if I looked at the same numbers in the S&P 500, okay, I would expect negative rates of return on the S&P 500 over the next couple of years just because it's overvalued for no other reason. Okay, so my first example here was Spire, good yield, highest yielding. The next one is kind of interesting because it is more of a growth stock. Okay, but what's interesting about this, and this is something about investing in growth stocks. I've got one right now that I've talked about in the past called Cigna, which has just started paying a dividend. It's not a contender, so I'm not covering it today. But I want you to note that Amgen started paying a dividend in 2011. Okay, their dividend streak is currently 11 consecutive years, and I'll show you more about that. It was very overvalued back in 2001, and I want you to note that that overvaluation generated a negative rate of return for almost the next decade simply because it was overvalued, even though the company was growing at 12%, 18, 37, 26, 33, 22, and even 6% growth during the Great Recession and then grew again coming out of it. But the point is, you didn't participate in that growth because you overpaid for the stock. Today, the stock is undervalued. It's offering a 3.3% dividend yield. It's an A-rated company with about 69% debt to capital, and I believe it's extremely attractive at these levels. Now, even if I look at the performance where I'm measuring it from overvaluation to undervaluation, I do want you to notice that it still almost created the same rate of return as the market. Okay, and it did pay $6,000 in dividends. It only paid dividends since 2011, where the market was paying dividends since 2000. So they had another 9 or 10 years of dividend growth, and it still outproduced, because look at the dividend growth rate here. Very, very powerful. Now, when the company first started paying dividends, this is very typical of new companies, of new dividend payers, a growth stock that morphs into a dividend growth stock. And that's what Amgen has done. So when I shorten this time frame, now when we measure this company from fair value to fair value, we start to see that it gets an edge on the S&P 500, not only in dividend income, but also in capital appreciation. Okay, measuring it from slightly undervalued to slightly undervalued. But now looking forward on this stock, it's expected to continue growing for the next couple of years at about 5.5%. The long-term growth rate is about 6%. But because the stock is so inexpensive right now, this is the margin of safety. This has the potential to generate double-digit rates of return of over 20% a year for the next 2 or 3 years, 17 to 20% we'll call it, just by virtue of the fact that it's so inexpensive today. And again, it's got a beautiful dividend growth streak. The dividend went from 56 cents all the way up to $7.04 expected for this fiscal year. And that's that powerful dividend growth that I just showed you. Amgen looks very attractive, and it offers you a 3.3% yield with very nice capital appreciation potential on top of that. The next I want to look at is Lockheed Martin. This is my favored aerospace and defense company today. I have a position in General Dynamics as well. I also have a position in Raytheon. I consider both of those moderately overpriced. Lockheed Martin is attractive, offers a 3.24% dividend yield. Lockheed Martin has increased their dividend for 19 consecutive years. And if I look at it from a performance point of view, they've buried the S&P 500 in income, and they've also buried it in capital appreciation. This has been a very strong over 15% grower historically, and you can buy it now with a blended PE of about 15 and an earnings yield of about 6.6%. I would call it attractively valued, but not necessarily undervalued, but I do consider it very attractive. Looking at it going forward for the next couple of years, I would expect double-digit rates of return out of Lockheed Martin. I might like to wait or look for an opportunity to buy this particular one a little bit cheaper if I could. And again, I'm only looking at these stocks through the earnings metric here. I'm determining whether or not I would want to research any of them deeper or faster. Cummins, the construction machinery and heavy trucks, primarily known famously for their diesel engines, a 15% grower with moderate cyclicality, but you can see the correlation between price and earnings over this time. It was slightly overvalued coming into the first of 2021. It's now fallen into attractive valuation. The company offers a 2.55% current dividend yield. It's A+ rated with only 32% debt and has a dividend growth streak of 16 consecutive years. Its historical performance relative to the market has been phenomenal, almost 10 times as much dividend income and a staggering amount of performance. 10,000 would have grown to over 239,000 versus only 34,000 in the market. A little tricky on that performance because of the cyclicality, but you can see that the price has gone where the earnings have gone. If you buy this stock at fair value, you participate fully in the growth of the company. It's expected to continue growing over the next couple of years at 18%. Does offer a nice about 20% margin of safety. Longer term growth is expected to still be in excess of 15%. I would consider this a very, very attractive total return investment, but also an above average current income investment at the same time with a very, very long dividend growth streak. I really like Cummins at these prices. If you get a little cheaper, that would obviously be even better. The next one is JPMorgan in the financial sector. It has one of the better records of most financial companies. It did cut their dividend during the Great Recession, But JPMorgan currently has a good long dividend streak. I don't have it off the top of my head, so let me go ahead and get it. I'm going to go in here to the Dividend Contenders list here. This is the Dividend Contenders, and I'm going to go to J, and I'm going to look up JPMorgan. They've had 11 consecutive years of dividend increases. So JPMorgan has been very attractive since coming out of the Great Recession. They've increased their dividend. Long term, the company was slightly overvalued and it's slightly undervalued here. So if I compare performance, it still outperformed the S&P on dividend income and outperformed it on capital appreciation and just slightly beat it on a total return basis. But again, if I shorten this time frame, and what I want to be clear about here, when I shorten the time frame, I'm getting it to a point coming out of the recession, it was fairly valued, grew at about 13.4%. At this point, I get, almost 13% capital appreciation. I outperformed the S&P on dividends, and this is during a time when the S&P has had very stellar performance. I want to make that clear. So JPMorgan looks very attractive, 2.4% dividend yield, A- rated, 35% debt, and trading at what I would call an attractive valuation today. The next one is Snap-on, Industrial Machinery Company. I like the long-term record of this business. I like the dividend growth. The dividend streak is now 11 consecutive years where they've increased their dividend. The company has dramatically outproduced the S&P 500 in income. It's dramatically outproduced it in capital appreciation and dramatically outproduced it in total return. It got overvalued about as early as May of last year. It's now coming into value. It does have good forecast growth of 11 to 12% going forward, which makes it attractive. It could be throwing off 7, 8, 9%. If I look at the long-term growth, it's closer to 10%. This could be a nice double-digit grower, but the key is here, and I want to emphasize this is just now coming into fair value. This is one, the ideal time would have been able to buy it when you bought it with a great margin of safety. But in light of today's overheated market, this is one that I think you should keep your eye on. It offers a 2.3% dividend yield. It's A- rated with only 22% debt. And again, I might be a little patient with this one and wait till it got a little cheaper, but I really like it. Ameriprise, which is the spinoff from American Express. Once again, you see this very consistent growth record of just under 12% per year. The company offers a dividend yield of 1.7%. Now, I want to contrast that just to be real clear. The yield on the S&P is 1.4% now. So that's, a above market average dividend yield now with some really nice growth potential. I think that's the real key. When I look at Ameriprise, they've had 17 consecutive years of dividend increases. They've dramatically outproduced the market in terms of total dividends, dramatically outproduced it in terms of capital appreciation. And again, I want to point out that it did this while it was going from attractive value to attractive value when it was competing against a market that is now currently overvalued. Okay, so that's a very important part of the process here. Forecasting, this company is expected to grow at 18% a year. I think this is extremely attractive. Its long-term growth rate, 3 to 5 year growth rate, is expected to be about 8% a year, but I believe this stock offers a really tremendous margin of safety, and there's no reason why this stock couldn't be trading at 15 times earnings. But even if it trades at its normal discounted PE ratio here, it's still a 12.5% grower. The market has been valuing this at about a 12 or 13 PE. I do believe, but there are times when it goes to this 15 PE. I think it's clearly worth 15 times earnings, currently trading at 13.3. Again, 1.71% dividend yield, A- rated with 47% debt. The next is Amerisource Bergen, a healthcare distributor, which has been, under attack with the opioid crisis. 1.49% dividend yield, earnings yield 7.81%. It is BBB plus rated. It does have quite a bit of debt, but it has a dividend streak of 16 consecutive years. I compare its performance to the market. It's significantly a better income producer than the market and generated significantly greater capital gains than the market, averaging over 12% to the market 7% during this same time frame. But keep in mind, this has been a very fast grower. Looking forward, the company is expected to grow double-digit growth. It could be a very powerful rate of return generator over the next couple of years. Even at a discounted multiple of, say, 14 times earnings, we got a 14% potential here. I like Amerisource Bergen very much. Anthem is another managed healthcare company that I think looks very attractive here. It's only been paying a dividend since 2011, but it does have an 11 consecutive years. In other words, it's increased its dividend every year since it's paid one. It's A-rated with 38% debt. This one might be, on the verge of calling it fully valued, but considering the light of the market, it's, basically what I would call a fair valued stock that offers double-digit return potential. It has only a 1.22% current yield. It's A-rated with 38% debt. However, it has outperformed the market dramatically in terms of capital appreciation and even dividend income, even though it's only paid dividends since 2011. And remember, the market, this is measuring the market with a dividend streak going back over 20 years. So, it's got a tremendous average dividend growth rate of about 16%. And it's, expected to continue growing at double-digit rates going forward. So I like Anthem a lot also. Next one would be McKesson, which is another healthcare distributor. And, you got Amerisource and McKesson here. Both of them have been really undervalued. Both of them have good, long-term growth stories. You can see that, McKesson has really grown earnings at over 14% a year. So even though they're undervalued, they still have outproduced the market. Dividend income has been about the same. This company only has about a 0.94% yield. However, I think it's important to recognize that it has increased its dividend every year for 14 years. So this is really a margin of safety, total return story, below market dividend yield, but it does have tremendous dividend growth. Now, I want you to note that, the dividend growth has, gone from 0.7% to almost 5%, over this time frame, average growth of about 12.5%, compound average of almost 11% historically. I just think this one is a margin of safety story and very inexpensive. BBB rated with 93% debt. And then last but not least is Globe Life. Now this one has a very low dividend yield of about 0.88%. What I really attracted to here is the consistency of this company's growth. So, you're giving up maybe a little bit of rate of return. If I compare this to the market, it's produced about the equivalent amount of dividend income. It's given greater capital appreciation than the market, despite the fact that the market's overvalued now. But, again, this is a life and health insurer that has very attractive, year after year growth here. And I think that's extremely important. The consistency factor here and the fact that you can buy it at an attractive valuation today means that you could expect to earn very strong rates of return over the next couple of years, assuming this stock reverts back to that 15 PE. But if I was simply looking at it from its normal multiple, which in this case is a 14 PE, it's still a 20% grower. If I even chose a lower multiple here, because of the consistency of this, this is using a 12.7 PE. I still get 12.13%. So there you have it. You have this, people were asking about dividend growth stocks. Remember now, I'm going to summarize this by saying these are dividend contenders, okay? They're companies that have increased their dividend by at least 10 years or more. I consider all of them fairly valued, some of them very attractively valued. I do believe these offer both, some of them offer some above average current yield. Some of them offer more future return or total return or capital appreciation than they do yield. But in spite of the fact that the market is so overvalued, these are all very attractive dividend contender, dividend growth stocks. Hope you enjoyed this video. You asked for it. I delivered, I hope. I appreciate you staying by. If you liked the video, give me a like, ring the bell and subscribe to the channel if you haven't already. This was a subscriber request Tuesday where I just presented some dividend growth stock research candidates for those of you who are interested in dividend growth stock investing. Thanks for watching.